Hello and welcome. You're tuned into Buy Now Sell Now with me, Ankita Saxena, and with me is Kanishka Sarkar. This is the show where we get all your stock-related questions answered. But first up, we are joined by the management of GIC Re. GIC Re has posted its numbers. Good set of numbers coming in, and the stock is seeing a reaction of almost 3.5% jump up coming in. Shree Ramaswamy Narayanan is now joining us, who's the CMD. Hi, Mr. Ramaswamy. Thank you so much for taking the time out and joining us. Mr. Ramaswamy, as I can see on a standalone basis, your GWP was flat on a year-on-year basis, but the net earned premium or the NEP was up a good 10%. What were the key drivers for the same, and can we expect a similar growth trajectory in FY26 as well, or do you anticipate a significant shift in either growth or margins during the year?
If you see, the gross profit was flat, but then honestly, both the quarters are not really comparable because last year in October, IRDA brought in a change in accounting where long-term policies, which used to be accounted in the same quarter that they were booked, now has to be accounted on a 1 by n method, which means that the premium needs to be apportioned over the number of years that the policy has been taken for. So that obviously means that the premium that is booked now will get spread over the next few years, which is why the current quarter is really not comparable with the last year's Q1. So we have shown growth if we consider that. Again, the earning pattern has changed because last year we grew, and normally what happens is when you grow, a portion of that is kept back for for the unearned premium, which has now got released this year. That's why you see a difference. On the performance side, we do expect things to be much better than last year. On the growth perspective, we expect to maintain our growth about 10%. Last year we grew by 10.7. This year also we should be growing between 9 and 10%. Margins will improve, as you have seen in the first quarter this year. The losses have come down. The losses have kind of stayed where they are, but the combined ratios have really come down by about 2.5%. And I think by the end of the year, we expect losses to come down by about 1%, by the combined ratios to come down by about 1%. We have been conservative in our budgeting, but I think we should be able to get that.
Hi, Mr. Narayanan. This is Kanishka also joining in. Very good morning to you. Now, you were just talking about the combined ratios, right? So in the last quarter, you indicated a target combined ratio of 106%. And this quarter, you've come very close to that at 106.9%. If you could explain to us what are the key levers that drove this kind of improvement? And also, are you sticking to the same combined ratio guidance, or has there been any change in in terms of outlook?
So we finished last year with about 108.8, and I think we should come closer this year to 107 is my feeling, looking at market conditions. Like you said, we've already kind of reached here in the first quarter, but our second and third quarters are normally quarters where we get impacted by catastrophic losses. So we are looking at that very keenly to see how that will change. Touchwood, this year has been a good one on the catastrophic front till now. We'll be monitoring how it does going forward. This year, we've already seen on the first quarter two major, what I would call as extraordinary losses. These are basically risk losses. First one is the fire loss of a company called Jindal Polyfilms based in Nashik. It was a big loss, 2,300 crores, 100% loss. GIC's share is about 40%. So we've already provided about 925 crores for that. Then the second one, of course, the very tragic event of Air India at Ahmedabad, which everyone knows about. So we've again provided a big amount there. So these are two big losses which have come and hit in the first quarter itself. So of course, we need to carefully monitor how these losses will progress going forward. But I think we have provided quite adequately, which is why the confidence that we should do a combined of around 107 for 25-26.
Right. Mr. Ramaswamy, what has been the overall impact of the Air India Ahmedabad accident on your books? And could you share the estimated liability or provisions made with that regard?
We have a 5% share, 5.15% share on the Air India risk, 4% on the obligatory, and 1.15 that we wrote on a facultative basis. Currently, of course, in the market, the idea about what will be the actual final total loss is still changing. Some people believe it will settle at around 200 to 250 million. We personally believe it will go to around 400 million. I had in fact spoken about this earlier as well, that it should be close to 400 to 450 million. This is of course putting across losses from all kind of classes, because this being an international flight, there were travel policies that were taken that will get triggered. There will be personal accident policies that will get triggered. There will be life insurance policies that will get triggered. There will be some marine insurance policies that will get triggered. And of course, the hull and liability of the Air India flight, as well as the third party liability for the unfortunate doctors who got affected by the plane crashing into their building. So all these put together, we believe should be close to about $450 million. We have accordingly provided for that in our books, and we will of course closely interact with all the authorities to ensure that the losses are played properly.
Okay, thank you, Mr. Narayanan, for that update. But, moving on, let's also talk about segments and products. Now, there's been a noticeable shift in the product mix you've had. Fire segment that has declined by about 4%, health by 3%, while the agri segment that has seen an increase of, significant increase of 9% compared to the previous year. So what are the factors that drove this change in the product mix? Additionally, could you also share the margin contribution from each of these segments?
Yes. So fire, like I said, it came down because there are long-term policies that we write there, long-term housing, which is a big product in the market. Where earlier the premium used to be booked in the same quarter that it was the policy was issued, but now it gets apportioned over the different years in which the policy has been taken. So to that extent, fire has seen a little dip. But I think personally, going forward by the end of the year, fire should do better than what it did last year in terms of the overall premium. Secondly, agri, we have seen a little bit of uptick there. Pricing has been decent. I wouldn't say good, but decent. We have written a couple of states that we didn't write earlier. So to that extent, there has been a slight uptick. But I think again, agri will more or less stay where it was last year by the end of the year. Health has gone down a little because we've been closely monitoring this class of business. We grew very well last year. Like you would know, it was a big growth for us. We grew almost 66% last year in health. But this year we didn't renew a couple of treaties because we were not confident that it would do well, because medical inflation is going up. Claims are going up in certain classes of business, certain classes of health. So a couple of treaties we did not renew. So to that extent, health premium will come down. And this is something that we had planned for, we had budgeted for. So overall, we expect that premiums will go up by 10%, but some of the growth will come from new areas like surety bonds and cyber and trade credit and things like that, which we are trying to write so that we can get the diversification in our books.
All right. Finally, Mr. Ramaswamy, what would be the impact if the mandatory 4% business to GIC gets removed, as many companies are asking for it? And what would be the impact if the mandatory 4% business finally gets removed? What is going to be the impact?
People want that capacity to go. My personal belief is it is not. There are a few companies asking for it to be removed simply because they believe that the commission that is due to them on obligatory, they are not getting. And that is simply because today the obligatory commissions are mandated by IRDA. The regulator mandates what kind of commission GIC should pay to each company for the business that they are seeding into the obligatory. We believe that should not be the case, and companies should be paid commissions based on the profitability of their book, based on the profitability of the obligatory sessions that they're seeding into GIC. So this is something that we are discussing with IRDA, and hopefully if that gets implemented, the obligatory sessions will stay. Because I've been speaking to all the insurance companies here in this market, and they're all very clear that this is a very good capacity which should stay, because new companies are coming in, new classes of business are being written. So a good capacity, good reinsurance capacity for all this would be definitely welcome. Secondly, just to take a call as to if obligatory sessions go, what will happen? Honestly, from a profitability perspective, I don't see a change, because the obligatory just about breaks even for us. So from from a profitability perspective, I don't see a change. But yes, there will be pressure on the fund, because there will be no fresh money coming in, but then we'll still be paying off losses and claims for the previous years of obligatory. So yes, there will be some pressure on the fund flow, which could affect our investments. But other than that, from a business perspective, I don't see a major problem happening here.
All right. Thank you, Mr. Narayanan. Thank you so much for sharing that outlook with us and discussing your Q1 numbers. On that note, we'll let you go. Great chatting with you.